Hi, I'm Anish from QED Capital, and welcome to our first episode of Tuesday Talk. The topic today is how many times should I check my portfolio? But besides that, I'm going to talk to you and take you through what happened in the factors, how factors behaved this week, and how the sectors behaved this week, and what was the correlation and what was the commonalities between the factors and the sectors. And then I'm going to talk about taking an example from Nicholas Taleb's book, uh, Fooled by Randomness, and talk to you about how many times you should check your portfolio. With that, let's get started. And this is just a little bit about us. We are a SEBI-registered PMS firm. We are perhaps the first quant-driven asset management firm in India among PMSs, and we have a long-term disciplined approach. We mainly look at the medium to long-term trends. So you can visit our website to know more about us. With that, let's dive into the agenda for the day. So here is the factor performance. We're going to do it on a weekly basis. So this is basically the factors, how factors performed last week, week ending 22nd April. And as you can see, none of the factors ended in the green. Value lost the least. It was down by about minus 0.3%, and momentum lost the most on a weekly basis. On a monthly basis, again, value has done the best, 2.4%. Momentum lost about 4.8, and the rest were somewhere, between 0.4 to minus 3 for quality. Let's look at year to date, and we can see again that value is leading the pack. Uh, Alpha low vol, which is a combination of momentum and low volatility, is pretty much up about 1%. Momentum is up about 1%. And it's small cap that's taking it off the chin, down 6%. This is something where we show what is the trend of the factors. So as you can see, value is the only factor which is there in an uptrend. Last week, even momentum, quality, and the market factor, which is nothing but the broad-based Nifty index, even they were in an uptrend. But this week, which is the week ending 22nd April, even that's gone into a downturn. And as we are recording this on Tuesday, the market's up a little bit, but it was down quite a bit yesterday. So I think they're still down, but we're going to check this on a weekly basis. So 6 factors down, only one factor, which is value, which is up. You want to read more about factors and what we do about that, you can subscribe to factorinvestor.substack.com, which we send out on a monthly basis. Let's move to sectors. And, auto has had a pretty good week last week. Energy, followed by energy, and then by infra. As expected, IT has been taking it on the chin, followed by finance and media and banks. FMCG is about flat, and that's broadly about it. Let's look at it on a monthly basis, and energies had a pretty good month, up about 9%. Autos, helped by its performance last week, is up about 3%. And again, it's you can see IT is the culprit, but IT had a pretty good 2021, so we can expect a little bit of mean reversion. It's not unexpected, and currently everything is being driven by energy and commodities, so it's not surprising to see energy doing well. And on a YTD basis, which is from January onwards, again, it's energy which is leading the pack, followed by metals. Again, not something to be surprised at. And we'll show you why in the next couple of slides. IT is taking it on, taking it really hard, down 16%, followed by realty, which is down about 7%. Pharma is down about 5%, and the rest of the sectors are just about, a flat to down or flat to slightly up. So no major trend there. Let's look at the trend in the sectors, and this is where you see that auto, which was down last week, is now in an uptrend. On a weekly basis, we basically look at the 40-week moving average to determine whether a sector is in an uptrend or a downtrend. Banking, FMCG, IT are both down. IT has been down for a couple of weeks now. Media is up. Pharma, finance, and have been down since a long time, so they are in a firm downtrend. The only major ones which are again not unexpected are energy, metal, infra, and media. And auto is just about which was in a firm downtrend, is trying to sort of get into an uptrend. So we'll monitor it closely over the next few weeks to see if anything interesting comes up there. Now let's look at the overlap between the value and the energy sector. Again, if you want to see this, you want to get this in your email box, you can subscribe to factorinvestor.substack.com. That's where we send this out on a monthly basis, as I mentioned earlier. This is what I was talking about. What are the top constituents which are common between value and energy? And let me just put the screen down there. And you can see again a lot of energy and metal names that you can see in the Nifty 500 Value 50 Index, except for ITC and Grasim, but the rest are mainly energy and metal names like Hindalco, Coal India, Tata Steel, Vedanta, which are the metal names, and the energy names which are ONGC, common with the Nifty Energy Index, NTPC, Indian Oil, Power Grid, again, which are common with the Nifty Energy Index. So you can see why both the value factor and the energy sector are doing well, because most of the top 10 constituents of the value index are from the energy basket. And of course, the other names that are doing well in the energy space are Reliance, Adani Green, Transmission, Tata Power, BPCL, and GAIL, which are the top 10 constituents of the Nifty Energy Index. With that, that's it for the weekly update. Now let's get into the topic for the day. And how many times should you check your portfolio? Before that, let me just take a minute and explain why factors work, because everybody knows the factor formula. Why do they still work? And I think the most common one, which has been backed by research and by academics and practitioners, is a lot of behavioral biases, and most common among them the prospect theory, the endowment effect, anchoring effect, about which we'll talk in later episodes. But today the one I want to talk to you about is loss aversion. Loss aversion is one of the most important ones, which sort of play into the endowment effect and the anchoring effect, and let's see how it affects us. So this is something that I've taken from Taleb's book Fooled by Randomness, where he takes the example of a dentist who's retired, and he is and we know a priori, that is in advance, that he's a good investor, and he's been fairly generous with the returns, that he's assumed that he's expected to earn a return of 15% in excess of treasury bills, with a 10% volatility, which is pretty much what you would expect of a top tier investor, because usually the volatility is more than return, but in this case he's taken an example where the return is more than the volatility. So he's taken this fictional dentist, and then he's looked at what is the probability that the dentist sees his portfolio in a loss or in a profit, depending on the time frame, or depending on the frequency with which he or she checks their portfolio. Before that, now let's talk about loss aversion. What is loss aversion? We as human beings, it's not a surprise that we prefer to avoid risk, and that's one of the reasons why we have survived till date. That's one of the reasons for the survival of the human race, that we've avoided risk, and and loss is a form of risk, and we don't like to see losses in our portfolio. However, what Daniel Kahneman and Amos Tversky, who unfortunately didn't get the Nobel because it's not awarded posthumously, but Kahneman was awarded that. And one of their most pioneering works has been in loss aversion, where they've sort of approximately told us that the pleasure of a 10% gain is not equal to the pleasure of a 10%, the pain of a 10% loss. If you've and they've sort of plotted this on the utility curve, and they've done a lot of research in the real world. So the pleasure that you would get from the gain of, say, two points, that same pain you will get if you lose, you will get twice the pain if you lose those 2 points. So basically, if you're up 10%, you may get your utility function may give you a, say, X, and if you're down 10%, the pain that you will suffer will be 2X of that, which is 20%, the equivalent of a 20% loss. So to make up for that 20% loss, you need to see a 40% gain. So that's how skewed the the upside and the downside utilities are in our heads, and that is why we when I show you the next slide, you'll understand why I'm saying that you should balance out checking how many times you check your portfolio, because if you're going to see your portfolio in a loss, say, half the time, and you're going to see your portfolio in a profit half the time, and the let's say the amount is approximately the same, you're still going to be left with a pain, because say you made a 10% loss and a 10% gain, your pain is still going to be equivalent to a 20% loss. So it's more painful to see your portfolio in loss. And this is what Daniel Kahneman says about it. That it's one of the most, there's significant contribution of psychology to behavioral economy. This comes from the field of psychology and is now, a very important part of behavioral economics. Now let's look at, what is the probability that you would see your portfolio in a profit or a loss, depending on whether you check it on a daily or a monthly or on a quarterly or on a yearly basis. And you'll see how it's not a linear scale but a exponential scale. Now, if you were to check, let's forget seconds and minutes for a bit. Let's look at every hour. I'm sure there are a lot of people who check their portfolio every hour. So between an hour and a day, you can say that you'll probably expect to see your portfolio in a profit or a loss half the time. If you move from a day to a month, that moves from 54% to 67%. So that means you're expected to see your portfolio in a profit 2/3 or 67% of the time versus 1/3 of the time. And this is where you'll be probably break even, because 2/3 of the time it's in a profit. So you're going to see many 10% or 20% gains, whatever they may be, versus you're going to see the 10 and 20% losses only 1/3 of the time. So that's sort of offset. So it's the break even point, I would say, to check your portfolio a month. If you're able to control yourself and just check it for every quarter, that moves up from 67 to 77%. And if you're like a complete stoic, which I don't think many of us are, you're going to see your portfolio in a probability of success of is about 93%, assuming your portfolio has the characteristics of the fictional dentist we spoke about, who is getting a 15% gain and a 10% volatility. However, we know that's not true in the real world. So these numbers would be far smaller. So I would say that if you check your portfolio a month, you would probably see it in profit or loss, say 50 to 60% of the time, 50% or 55% of the time in a profit, and the rest of the time in the loss, and so on. So why would if it's not your full-time job, if you're not a full-time investor, why would you put yourself through this pain? And what are some of the things that you can do to control your behavior? First of all, focus on asset allocation. If you have your asset allocation in place, then then you will not be tempted to check your portfolio, because it's not going to change the needle on a daily basis. Maybe once a month or once a quarter is more than enough. if you have an investing and trading plan, even if you're not a full-time trader and you're trading on say a slightly longer term charts or longer term time frames like a weekly or a monthly time frame, and you check your you automate your strategy, and you just execute it and see your portfolio on a weekly or monthly basis. That's one thing. Set up alerts, automate your investments, and for most of you who do, who it's not your full time job. Investing is not your full time job. I would say the best thing is just have an advisor, and it's his job to take the pain and monitor your portfolio. If there's something untoward happening, if there's something that he needs, he needs your input on, he'll alert you. So, he's watching it on your behalf. So it's not that your portfolio is going unwatched. Somebody is taking a look at it. So why put yourself through that pain? So with that, we come to an end to this Tuesday's topic, which was how often should I check my portfolio? So thank you very much for watching. You can follow me on Anish Daily on Twitter. You can follow me on also QED Cap on Twitter. You can go to our website where we have a number of articles and blogs on systematic investing, on behavioral finance, and a lot of other things. And please don't forget to like, subscribe, and follow our YouTube channel. This is our first video. Next week, we're going to come out with something very interesting, which I think is going to be very useful in these times, and something that is actionable. So keep a watch out for that, and see you next week. Stay safe.